Okay, in this video we're going to talk about what are referred to as multiplier models. Some textbooks refer to this as stock valuation comparables. But essentially it all works on a very basic kind of a formula, that there is a connection in a formula to market price. And if you solve for market price, you end up with a formula that if you change the values or change the variables to forecasts, instead of getting the market price, you end up with the forecast of a value. So here is the first of those, and one's called the PE multiplier. The PE multiplier, quite simply, is just the company's PE ratio multiplied by the estimated earnings per share. So let's talk about the two variables. First of all, the company's PE ratio. That could be today's PE ratio, or it could be the PE ratio 1 year away. So let's look at Yahoo Finance and see where we could find this. If you look in there, this is Coors, the company that I've been following. Under the category of key statistics, we're going to find most of all the variables that we need here. So here is two PE ratios. This is the trailing PE ratio. That's the historic number, 27.29. And the forward PE ratio is 18.21. So we want to forecast the value of this stock 1 year from today. So we would want to use the forward ratio, the PE ratio of 18.21. And as you notice, as I'm changing these are things that have changed since I've done this the last time. Where would we find information about earnings per share? Well, we can float down here. We can go down to the bottom. Down here is the deleted earnings per share. It's $2.76. What we need, though, is we actually need to know the future. What do we think is going to be at the end of 1 year? Now, where we can find that, if we scrolled over here a little bit to the left, is we can find under what's referred to as the Analyst Estimates. The Analyst Estimates come up here, and what we can find here is earnings per share. So let's see where we can find that. Here's earnings per share estimates, right? That's not the number. This is December of 2014. We don't need that number. What we need to do is to find earnings per share. Here's the year ago earnings per share, and here is the current year. They expect this on December of 2015, and here's what they expect on December of 2016. So we want to use this faraway number, $3.89. Again, we can find that under the section that refers to analysts. So again, what was that number? $3.89. So if we plug $3.89 in here, we have a forecast of the value of this stock 1 year from today as 70.837. So now let's go back and take a look at this. So let's go back to our company. We want to find the summary. And if you look at the summary, the current price is $75.40. $75.40. So let's get that up there so we can keep making reference to it as we go through this example. So you can see what they predict the value a year out, or on December 16th of 2016, to be $70. It's currently $75. So we're assuming here that they think that the stock price is going to fall. What about the next one, which is the enterprise value multipliers? Now, we've talked about enterprise value. That is the cost of buying all the stock, paying off all the debt, and then, of course, to do some of that, you're going to use the cash of the company. So essentially, this is the number that costs to buy the company and convert it into an unlevered, or a company with zero debt. That's the enterprise value. Enterprise value. The multiplier is you take that value and you divide it by EBITDA. So let's look at our numbers. What is the multiplier? Well, again, we have to go back here, find our key statistics again, and we want to find the Enterprise value right here is 20.55. Just plug that number in, 20.55. What is EBITDA? Well, let's scroll down here. See, here's EBITDA, 798.10. 798.10. There we go. How much debt does the company have? Total debt, $320 billion. So we need to have this is 3200, $320 billion. What about how much cash do they have? 624.6. 624.6. How many shares does this company have? Again, if we look over here to the right, we can find the outstanding shares, 183.32. 183.32. So now we have a stock value of $75.41, which is exactly what the stock price is right now, $75.40. We're off a penny. So the enterprise value multiplier says that the current stock price is pretty much the value of the stock. What about price to sales? Well, we need to find the price to sales data. Here's the price to sales ratio, 3.29. Put in here, 3.29. What about the estimated sales for the company? Maybe we can find this under the estimates block. So you go to estimates, here's revenue, here's the average, here's $3.82 billion is what they anticipate December 16th. So let's go back here. All right, 38200, we got that. The number of shares, 183.32. We have the number of shares. So that's $208.37. And they're saying that the value of this stock is $685. Actually, I think this is our problem right here, that this should be 382.2. Let's go back and find the estimated sales is 3820. 3820. So now, again, putting in the right information, this one says that the stock is actually worth $68.55, 56 cents. So again, we say what? That essentially we're saying the two of these models say that the value of the stock is going to go down, and one is saying that the value is going to stop, or at least stay very close to the same. So what is your analysis? Essentially what we'd say is you probably don't want to buy more of this stock if you own it. You might not want to necessarily sell it, but you certainly want to keep very close eye on what might happen in the near term. You want to make sure that you don't lose this value, this $7 here. You don't want to see it go down too drastically before you might decide to sell. What do the actual analysts say? If you go to Analyst Opinions, let's see if they agree with this. I don't know if they will or not. But if you see here, it says the mean recommendation this week is 2.3. So 1.0 is strong buy, 5.0 is sell. This is what? Right in the middle. So they're saying basically, look, you don't want to buy, you don't want to sell. It makes a little bit of sense maybe just to hold right where we're at. Again, these things don't always match exactly up with us. I mean, look, the mean target moving forward, they're thinking the stock could be as high as $85. The low target is $78. Well, that's still a $2 increase, or a $2.50 increase moving forward. So again, some of the data is different. Some of it is conflicting. I mean, that's the nature of valuation and analyzing company stocks. So that is the multiplier models. We actually have a version of this in the stock valuation worksheet that we'll talk about a little bit later so that we can get a whole big picture of what goes on with a single company. But this is applying this to actual real data.